Hello, everyone, and welcome to Brandeis International Business School's inaugural Trends in Asset Management Conference. My name is Perry Traquina, and I chair the Asset Management Council at IBS. I'm also a graduate of Brandeis University, class of 1978, and have served as chair of the Brandeis Board of Trustees, and am now an emeritus trustee at the university. I'm also proud to support IBS's efforts in asset management and those that highlight IBS's students, alumni, and faculty. As some of you know, I spent my entire career in the asset management industry, working for 34 years at Wellington Management Company, a large global asset manager, where I was an investor for 17 years and then an executive my last 10 years at Wellington, were as chairman and CEO of the firm. We are excited about the next 2 days of virtual programming. Today's sessions are focused on climate change and sustainable investing, and tomorrow our sessions focus on private capital markets. This conference includes both industry practitioners and academic panels, so it should appeal to a broad swath of professionals. And this variety is a testament to the quality of the faculty at IBS and to the students and alumni who support IBS and Brandeis. As a reminder, the link that you are using for this session will be the same link that you can use for the rest of the sessions for our conference. I'd also like to acknowledge the Rosenberg Institute of Global Finance, founded and envisioned by Barbara and Richard Rosenberg, and the Brandeis International Business School Asset Management Council for supporting this event. Without them, the conference would not have been possible. So with that, let us begin with our first panel of the conference, which focuses on the important topic of sustainable investing. Environmental, social, and governance investing, ESG, has been one of, if not the most important vectors affecting the investment landscape over the past few years. It is shaping funds flow, proxy voting policies, corporate planning and resource allocation, corporate disclosures, and a great deal of conversation between corporations and their stakeholders. This vector is highly likely to continue to shape investing for many, many years to come. My good friend and Asset Management Council member, Rob Brown, will be the moderator for this panel. Rob is a 1988 graduate of Brandeis and a member of the Lemberg Program in International Economics, class of 1989. Rob has had a distinguished career in financial services, having worked at Morgan Stanley, Nomura, Alliance Bernstein, and now as founder of Atlas Impact Partners. Rob has assembled an incredible panel today, so without further ado, let me turn things over to Rob Brown. Rob?
Thank you, Perry. Appreciate those kind words and very much appreciate everything you've done to help support Brandeis, the business school, and of course, this conference. So I have, as Perry said, been in the world of investing, largely research and investing, for over 30 years. And along the way, I've never lost sight of the idea that, as my parents taught me, the only thing you're supposed to do before you leave this world is to find a way to leave it better. And with that in mind, I've always had sort of two sides to my approach to life. One was professional, one is personal. And it is extremely gratifying to me to see the change that Perry referenced earlier, to see that what we now have is an investment community and dare I say an entire world that understands the implications of combining an approach to investing that includes an analysis of what an economist might call the externalities. We're going to get right to it. We're going to get to it, meaning this discussion with a group of individuals who are thought leaders, who in their own right have really been at the forefront of motivating the world towards that state. And if I were to roll the clock back 30 years, I can't imagine a group of more dedication that would have had more impact. We certainly thank all of them in advance. I'll start by introducing Priscilla Sims Brown. Priscilla is the president and chief executive officer of Amalgamated Bank. She's also been a multinational board director and a C-suite executive for years, and has been in the financial services world for more than 30. Prior to joining Amalgamated, she was the group executive for marketing and corporate affairs at Commonwealth Bank of Australia. It's important to note, for those of you who don't know, Amalgamated Bank is, to use their words, the bank for people who care what their money does in the world. For those of us who do care about these issues, they're a thought leader, they're an innovator, and they have a long history of corporate social responsibility, having been founded in 1923 by the Amalgamated Clothing Workers of America. Their mission-oriented organization has deep roots in the communities they serve, and today that mission really spreads deeply into areas of environmental lending, as well as an ongoing commitment to social justice for employees, customers, and the broad community. I know Priscilla will have a lot to tell us about her leadership of that organization and their commitment to all of those issues. So Priscilla, thank you for joining us. Tim Dunn is the co-founder and chief investment officer of Terra Alpha Investments, which is a fund management company with equally deep commitments to developing an understanding of how evolving financial and environmental trends and patterns interact in an increasingly interconnected global economy. That's another way of saying that Tim bakes these issues into everything he thinks about and his team thinks about when they're analyzing an investment in the public markets. Tim has deep experience and he has a long tenure as an investor. He spent the majority of his career at Capital Group, where he was the lead portfolio manager for one of the largest and most successful funds in the world at that time, the Growth Fund of America. And in total, Tim was responsible for $26 billion in AUM, assets under management. Tim is also personally a passionate advocate for the environment. He's been an advisor to the Carbon Disclosure Project and a trustee of the Nature Conservancy. And last, but certainly not least, Anaket Shaw. Anaket's CV is so long, I could take up the whole session here telling you what he's accomplished and what he believes. But currently he is a managing director and global head of environmental, social, and governance and sustainability research at Jefferies Group. He's also senior fellow at the Columbia Center on Sustainable Investment, where he leads efforts on environmental, social, and governance investment research in the public and private sectors. Anaket has also served as the program leader of the Financing for Sustainable Development initiative at the UN Sustainable Development Solutions Network. In that role, he advised national governments, global financial institutions, and nonprofit organizations. He also played a leading role at the recently formed Sustainable Development Goals Center for Africa, where he will, looking forward, lead the center's work on sustainable finance in Africa. He has also spent time at the Earth Institute, and for those of us who care about these things, he was an investment banker at Goldman Sachs. Anaket serves on various boards. He's an advisor to leading organizations around the world. He is the international treasurer of Amnesty International. He was chair of the board of directors of Amnesty International USA. He's a member of the National Council of World Wildlife Fund and the Economic Club of New York. And we're blessed to have him and his thoughts, along with everyone else's thoughts, here with us. So thank you all, each and every one of you, for joining us. I'm excited to get going. So why don't we do that? So let me start first by asking each of you panelists, maybe just for ease of introduction in the order I introduced you, just describe your organization's approach to issues of sustainability. And if you could, just give us some references to issues around the environment, as this panel is focused on, as well as people. And Priscilla, I'll start with you.
Okay, thank you, Rob, and thank you, Brandeis. This is a great opportunity to talk to people of like mind, and hopefully we all learn a little bit from each other. Look, sustainability is a big topic. It's important that people understand there just isn't a uniform approach to the E, the S, or the G. For that matter, in environment, social, and governance issues, there are lots of ways to look at it. I believe that Amalgamated Bank is a standard bearer in ESG goals, performance, and also in transparency. We approach environmental and social issues in two ways that set us apart in this increasingly crowded space. We're, by the way, excited and welcoming of the crowd. First, we put environmental and social considerations front and center in all of our business decisions. We're leading the way in community development financing, which brings capital to under-resourced communities to invest in climate resilient housing, for example. We value diversity in the workplace, and we publish our diversity statistics. 60% of our workforce identifies as people of color, and 60% identify as women. That brings me to my second point. We're transparent. We publish information about how we perform against the standards we set, so the people who care to know can see what we're living up to and see that we have a pledge to be America's socially responsible bank that goes beyond words, but actually in deeds.
Thank you, Priscilla. I'm looking forward to getting into all those issues with you shortly. Tim, over to you, please, for a little bit on Terra Alpha.
Sure. And before we do, just because someone out there might be looking at my bio and or know a lot about Capital, and I want to clarify one thing you said. Capital has several lead portfolio managers for the different funds, and I was one of the lead managers in Growth Fund America, but also as in Euro Pacific Growth Fund, as well as Capital World Growth and Income Fund. So it's a slight distinction, but people who know Capital would go, wait a minute, there is no one lead manager of those funds. It's a multiple portfolio accounts system. Anyway, to Terra Alpha, thank you. And thank you to Brandeis for doing this session again this year and having this conversation. So Terra Alpha is a 100% employee and investor-owned asset manager based in Washington, D.C. We were founded in 2014 with a 100% dedication to sustainable investing. And our philosophy is to allocate investor capital into publicly traded companies that are profitably leading the transition to a truly sustainable economy. And those two things are really important because we're looking for companies that will be increasingly profitable as they transition, as they manage through the transition. And we define a truly sustainable economy as one that actually serves the needs of people while working within the regenerative limits of our planet's natural resource systems. And that is, it would actually be an economy that actually, is sustainable and can continue into the future. We are a signatory of the Net Zero Asset Manager Initiative. Sorry, ambulances go by in our street, just a normal route, so I apologize for that. So we're a signatory of the Net Zero Asset Manager Initiative, and we are the only U.S. asset manager who's with a verified science-based target for our greenhouse gas emissions, which cover both our operations as our portfolio. And Priscilla will rightly mention that they are the only U.S. bank that also has a verified science-based target. So you're speaking to the only two U.S. financial institutions that have verified science-based targets for greenhouse gas emissions. And I'll stop there.
Anaket, over to you, please.
Great. Rob, really wonderful to be with you, and Priscilla and Tim, such esteemed company here. Rob, I just want to take a moment to thank you for your leadership on so many important topics with regards to ESG and finance. So, we are all rooting for your continued success, and we just really appreciate it. Makes the industry better. So I have this incredibly privileged job where I get to talk to and learn from and perhaps provide some useful advice here and there to some of the smartest people in the world who are trying to make change. Three of them are on this panel with me. And what I wanted to just get across to the audience is that there are now tens of thousands of very bright, motivated, thoughtful people trying to figure out how do you integrate a set of ideas that until recently haven't really been part of the way the financial system operates, certainly not how the economic system operates, around climate change, around social inclusion, around racial equity. How do you make that part of the system and evolve the system to respond to both the risks and the opportunities that those topics address? And in my job at Jefferies, which is a top 10 global investment bank, we are engaging with hundreds of asset management firms and several thousands of companies as they are all trying to figure out this topic as well. And the punchline is really that it's sort of, as Billy Joel sang in that song, Shades of Grey, it is a very difficult set of topics. There are very few absolute rights and there are very few absolute wrongs. Like everything in this world, we are in a spectrum of grayness around how do you incorporate climate change into your thinking, how do you incorporate diversity into your thinking, and so on. And what we do at Jefferies is we try to provide very clear, very thoughtful guidance to help investors, CEOs, and other stakeholders navigate through this ecosystem. And I'm really delighted to be here and to be talking about this in more detail over the next hour.
Thank you, Anaket. Thank you, everyone. Why don't we get right to it? Anaket, could you get us started perhaps with a framing of the issue, the scope of the challenges, if you will, particularly regarding climate change, and I know what you believe to be an extreme immediacy of solving the problem.
Absolutely. So Rob, since we're in an academic setting and with very bright students and professors and others, I can be a little numerate. So just forgive me, I'm going to just throw out some numbers and just give you a sense of the scale of the challenge. The world today has roughly 7.8 billion people, and the economic output is roughly $100 trillion a year. That's $100 trillion of economic output per annum that these 8 billion people produce. In so doing, we emit roughly 50 billion tons of CO2 and their equivalents every year. Okay, 50 billion tons of this, when burnt through oil, gas, and coal, through our land use, and so on, is released into the atmosphere. The challenge of sustainable development is the following. How do you take $100 trillion global economy, grow it by 3% a year, which is its long-term average growth rate, 8 billion people going to 10 billion people by mid-century, and do so in a way that we go from 50 billion tons of CO2 and its equivalents down to zero in around 30 to 50 years. That's the challenge that we're all talking about. That's what net zero in some ways means. That's what the Paris Climate Agreement calls for, and so on. And that is nothing short of a complete transformation in every single thing that we do. In our energy system, in our transportation system, in our agricultural system, in housing, in buildings. We need to basically rebuild the entire world, or take what is our built economy right now and reconfigure it in just 2 generations. And that's never been done before. It has absolutely never been done before. If you run a regression right now of global CO2 versus global GDP for the last 60 years, you get an R squared of 0.96. In other words, they're almost perfectly correlated, that as the GDP grows, so does emissions. And we need to not just break that relationship, but continue to grow if one believes in a growth-oriented system, and then reduce emissions not just to zero, but then to negative by the second half of the century. And the project that we all have ahead of us is that this is possible. This is not impossible. It is possible technologically. It is possible with the science and the trajectory of the science and the breakthroughs that are happening every single day. But it requires a rewiring of our social institutions, of our financial system, of our economic system, of our policy system, of how corporates behave, and so on. And what folks like those of us on the panel are trying to do is we're trying to all contribute to that, to the nudging of the system in to help solve that major global transformation. And it's a remarkable exercise. And I'm sure like Priscilla, Tim, and you, Rob, once you start thinking about this, you can't stop thinking about it. It becomes all encompassing.
Amen to that. Agreed. Thank you, Anaket. Priscilla, you've got an equally compelling perch when it comes to issues of social responsibility. Amalgamated Bank is 99 years old, and you obviously have been, not you personally, but the organization have been committed to a better role for companies and society since then. Can you help us understand a little bit how you frame out the problem and what you believe Amalgamated's contribution is to the problems of society and finance as they intersect?
First, let me say I love the way my colleague just framed the problem, because I think part of the challenge here is to keep it simple, right? To make it so that everyone actually sees their role and place in the problem and the solution. And so kudos. And when I think about the role we or companies broadly play, Rob, I think that's where you want me to go on this. Yep. We produce the and distribute the goods that were just being discussed. And so we're providing services for society, and we have to be additive to the well-being of the economy to have the license to continue to operate. That's the agreement, the implied agreement for us. We also need to be resilient to risks that come from poor practices or outside threats. And corporate social responsibility takes that risk. It takes the interests of shareholders and all stakeholders into account to ensure that corporate actions generate positive social value. We can't harm any of our stakeholders. That's the basic rule. It's actually core to how the economic system works as well. And so at Amalgamated, we've woven corporate social responsibility. As I said, it's in everything. What's interesting is that the current environment, particularly in the US, is that with so little happening on the public policy side to adapt to the new economy, it's even more important for companies to create sustainability and stability and resilience for the economy and for all the communities we serve. So as the government steps back, it's our job to step up. And it's right that we step up because we produce the problem. So we should be first and foremost focused on the solution.
Thanks, Priscilla. One of the, I guess, areas of pushback that some folks would offer to what both you and Anaket have said is that, well, the world of commerce, the economy, really ought to follow Milton Friedman, right? And the role of a company is just to make money. Now, we all believe that's a false debate, but maybe each of you could help us understand why you believe that's a false debate, and why you think there is no need to give up return. And in fact, why, as we all believe, there's actually a lot of return if we can just get ourselves motivated towards the future and stop thinking about defending the past. Tim, maybe we'll start with you.
Sure, and let me maybe paraphrase a little bit some of the things Anaket said and put it to context. So, we've all benefited, humanity's benefited greatly from the economic growth of the last 100 years, thousands of years, but particularly the last 100 years. And it's very visible in the sense of the ability for our population, our species, to grow rapidly. And at the same time, partially because we've reduced things like child mortality, and we've increased life expectancy, and we've reduced poverty at a absolute level. There's still too many people in poverty, but there's been great benefits to humanity from this. But it's come at a cost that we didn't necessarily understand until now, or until recently. And that cost is we've been overusing the planet, the things that that are essential to not only all species, as like around things like fresh water and clean air, but also humanity and our economy, that are things that are required to have a thriving economy. So we are now facing a situation where those things we didn't really pay attention to, the externalities that we were either Milton Friedman or accounting standards or whatever, we just could ignore. And those no longer are ignorable, right? You can't unknow the fact that the deterioration of soil health, the deterioration in clean air, the deterioration in water availability is impacting companies today, and will increasingly be important to them, at the very least from just a risk issue, if not from an opportunity issue. So I think that this narrative that these are things we can ignore is clearly false. We all agree with that, and that it has implications for companies and society today. So the way, and I think one of the things is, so what do we do about that? That's great. We all kind of know that, but what are we actually doing about it? And our whole premise is we're trying to find companies that are working on the right side of the ledger. They understand these issues are important. They're trying to figure out how to manage them more effectively. And we're trying to both benefit from investing in those companies, allocate capital to help them, but also provide a further nudge, right? That whole idea around nudge theory. And we think it's really important, because if shareholders are actually putting their money into companies that are actually working on the right side of the ledger on these issues, that is not only a better place for them to be invested, but also they can help with the change that we need to go to as we transition. So I can get into a little bit later, I don't know if we want to do this now, kind of how we assess companies on that, but that's sort of my thought process, that the companies that are going to be the successful companies of the 21st century going forward are those companies that get it and are working to manage to the needs of all stakeholders, because the ability to distinguish between what's good for your employees and what's good for your customers and what's good for your shareholders is going away.
Thank you, Tim. Maybe if you could just take a minute and tell us about, I think, what you characterize as environmental productivity.
Sure. So, obviously, as you've already heard me say, we think of what is happening to our planet's natural resources, which are essential components of a thriving economy and society, and try to develop a methodology for us to assess a company's position in regards to how they use and impact those natural resources. So we framed it around language that most investors and economists can relate to, which is how productive are they in the use and impact of natural resources, or the environment, as we call it. So ultimately, it's an effort to assess the ability of the company to manage these changes and these challenges. It's both a quantitative as well as a qualitative process that our analysts go through. In fact, it's getting increasingly qualitative as we increasingly are looking forward in where the company is going, because it's nice to know where they are today, but it's what are they doing going forward? What are their plans? How intentional are they? And what is their rate of change? And what benefit are their operational changes and product and services going to have to lead this transition to a more sustainable economy? So that's kind of there's a lot of depth to that. That's in a nutshell. It sits beside a deep, what we call enduring business model assessment, which really looks at all other elements of a company, and from their business strategy to the management and their finances, to understand that. But we have these two kind of key components that we must understand about a company before investing. And increasingly, we just figure it's just table stakes for companies to be working on environmental productivity issues. They have to be doing that for us to consider them, and they have to be leaders in their sector and their peer groups.
Well, thanks, Tim. That's a great segue to Priscilla. As a leader in the commercial areas of, the environment. Priscilla, maybe you could take a few minutes, talk about your lending to support the solar sector, servicing the solar sector, and how committed Amalgamated is to that area.
I think if it's okay with you, Rob, I'll even talk about it a little more broadly in terms of what we're doing to invest in ESG
Sure.
and both internal and external practices overall. Because I think the point Tim is making is that it's there isn't a single thing you have to do. You've got to be committed to this and look at every part of your operation. As you said, we were founded by the Amalgamated Clothing Workers Union, and it was just a group of immigrants who couldn't find financing, they couldn't get banked, and so they had the wisdom to set up their own bank. And we've sort of followed the needs of people who are most impacted by changes in climate as well as other broader environmental factors. And so we do things like we offer unsecured loans for working families. That's something that's considered taboo by many. We finance union-supported housing. We give bridge loans to boost earnings potential of skilled immigrants, people who don't have track records and FICO scores that tell the full story. We offered foreign exchange services for immigrants long before anyone else, mostly to European immigrants who were in the industry, clothing workers industry, but then more broadly to developing countries, which was very difficult to do. We loaned money for affordable housing and created the first free checking account for people who couldn't afford to pay for that. We raised our minimum wage first to $15, then to $20. We're pushing ourselves to go higher and asking others, including stakeholders from customers to suppliers, to consider the same. We added LGBT individuals to our corporate board diversity guidelines. What I'm trying to give you a sense for, I could go on, the list is long, but it's to look at every part of the business. We believe that our mission is our business and being a trusted partner for our clients, and many of whom go to work every day to affect positive change. So what's interesting about each of these firsts was that it was the result of a dedicated team of bankers and professionals staying true to this mission, having heavy debates internally about why we weren't doing something, and then figuring out how we could get it done. And today, that's what's helped us build out new areas of business, such as sustainability. We've grown lending to climate solutions from 0 to 31%. So 31% of our book as of this most recent quarter in 5 years. So think of that, a third of our work goes to sustainable financing, whether that be geothermal, whether that be PACE loans, other solar loans, wind, you name it, but it's all within the climate universe. So it's just an approach that banking will always work. We obviously really believe that we can not only do good and do well, which everyone sort of begins to talk about, but we think we can actually do well through doing good. And we think that over time, that's going to be a necessary ingredient. In other words, in order to eliminate the possibility of stranded assets in some of our sectors, we're going to have to think about the longer term growth of those sectors and make our investments wisely, considering climate and all of ESG to make that happen.
Fantastic. Thank you, Priscilla. That's a great overview, and we certainly appreciate all the work you guys continue to do. Anaket, could you broaden that out for us, perhaps? I know you speak to corporate leaders, investment leaders across both communities. What are people thinking about that trade-off that Priscilla referenced, or lack of a trade-off that she believes Amalgamated needs to make?
Yeah, it's really a wonderful and a nuanced question. Is there a trade-off between doing well and doing a good? In some ways, the answer is how you define doing well and doing good. So, and I hate to be academic like that, but defining what one's objective is very important. Doing well depends on what is your benchmark? What are your standards? In some ways, to Tim's excellent point, what we've been doing for the last 200 years is we haven't been paying for things that we should have been paying for. And if you start paying for those things, then over the short term, your earnings will go down. Over the long run, though, your company will be more sustainable, the planet will be more sustainable, and so on and so forth. So I don't think it's a trade-off really between doing well and doing good. I think it's a trade-off between short-term profits versus long-term sustainability. I think that the temporal part is often missed. But I don't want us, at least I'll speak for myself, I don't believe that the industry should get too much into this win-win-win mentality, because it makes folks think that there isn't a price to changing our behavior. There is a cost to this. Let me just throw out again some numbers. One of the things that we talk a lot about in the environmental world is around putting a price on carbon. Okay, what does that mean? That means that for every ton of CO2 that we emit, there is actually some damage that ton of CO2 causes. And over the last 50 years, thanks to a lot of great work pioneered by Professor Bill Nordhaus at Yale and the social cost of carbon, and then improved upon year after year with many others, we can sort of say, what is the cost of that ton of CO2 in terms of damage to the world economy? And then you can discount that to today and say, well, what is the cost that should be internalized by the emitter of that ton of CO2? And there are a lot of debates around what that price should be, but there's general agreement that in the next 5 to 10 years, we need to get that, Rob, to $100 roughly per ton of CO2. Now, we emit around 50 billion tons of CO2 and its equivalents a year. So 50 billion times 100 is $5 trillion. Okay, that in terms of the global economy, $5 trillion of unpriced, as of today, externalities that we are putting out there, but we're not paying for. So someone has to pay for that. There will be implications of that. Someone is going to have to pay. Now, the point, though, is that when that signal happens, there will be innovation. There will be changes in behavior. The system will reorient itself, now knowing that that thing that we weren't paying for, we are now paying for. It's similar to people, when we didn't have a minimum wage in this country, and now there's a minimum wage and a lot of discussion about increasing that or having a living wage. There is a cost to this, but over the long run, having a healthy workforce that likes working at your company, that's well paid and so on, will make your company a better company over time. So what the conversations that I'm having with investors is not these days whether climate change exists. It's not whether this is a problem that humanity is going to go after, because we are going after it. It's just, how do you balance these temporal trade-offs between the short-term costs and the long-term benefits? And I think here, what we need from investors and from executives at corporates is a longer term orientation. We need asset owners to allow asset managers to not look at their performance every month and say, hey, why are you underperforming your benchmark by 50 basis points? That kind of stuff, it's just not very helpful. It's part of these social rules that have to change a little bit in order for the folks that we speak with to be able to make the long-term investments, which have short-term costs in terms of lower returns, but in the long run, I think will certainly pay themselves out. So I think that's the key point. And then the other point I'll just make on this, Rob, is there's always it's very important when one is an investor and as a student, because there are students on the line too, to think about the various sets of institutions in the world and what their functions are. And investors and corporates have a certain function in society. Government has a certain function in society. Civil society has a certain function in society. Academia has a certain function in society. And the trick is to get them all working together cohesively. And what we shouldn't do, I don't think, is make companies try to, in and of themselves, solve social problems at any cost. Because if that happens, then they're not doing their job, which is trying to be efficient capital allocators and provide returns to shareholders and so on. I think what we need to say is companies need to do that, but the government needs to do its job too, which is setting the rules of the game. And if you set the rules of the game a certain way, then the players in the game, which is all of us, will change what we do. And I'll just end by saying, I see this, I work at, if people follow the, financial industry, they'll know Jefferies is it's a hard-edged, fast-moving investment bank. This is a company that is doing certain things for commercial reasons. And their approach to ESG and our approach to ESG is the rules of the game are changing, and therefore we are participating in it to make a higher return on equity for our shareholders. And that's because policy has changed, regulation has changed, customer preferences have changed, and so on. So the point I'm trying to make here is that we should never forget the role of all these other parts of society and make sure that they are doing what they need to do so that business and investors can do what they need to do. And by the way, not to support Milton Friedman naively, but that was one of the arguments he made in Capital and Freedom when that came out, that it's about government setting the rules of the game and business operating within those rules.
Thanks, Anaket. Let's get specific about some of the issues that you talked about. In fact, we have a question. Someone wants to know if this encouragement of long-term sustainability versus short-term profits is something that the business investing world will be able to do for itself. I personally, and I know you all agree, think that absolutely is the answer to that. But maybe Tim, Priscilla, you could give us some specific examples, right, where you are making, sorry to be crass, but you're making really good money either for your shareholders or your investors by focusing on these issues.
Tim, do you want to go first?
No, I want you to go first.
Okay. Look, what I would say to that is we are, by our existence, I think, frankly, Tim and the work he does in identifying companies that are profitably moving into this space, I think we do it, albeit we're a small example. I think we are we are one of America's experiments in this area. And I think what we're all proving every day is that there are really, there's customer interest, there's investor interest, and that we really can, and don't mean to disagree with one of my colleagues here, but I do think that we can do well and do good. And I do think we have a responsibility. While I don't at all help anyone abdicate their responsibility, least of all government, I do think that we can make a difference where we can, and that investors and customers are responding to that. We see it every day. So, for example, we are investing in our operations where we think it's really important, helps customers think about buying, retaining, and recommending us. We may not invest in some bells and whistles that other companies do because we think about our resource allocation differently. I think that when we're investing in CDFIs and affordable housing, for example, and we're spending quite a lot of extra time to do the research, to get those programs right, work with the customers to make them bankable and ready. That may not be something that another competitor, another bank might do. They might make other investments that they may put more in advertising. They may make other decisions that we don't make. I believe that investment I'm making is in the long run going to produce a better product and be better for society. And so there's resource allocation decisions we're making all the time. And it doesn't necessarily mean that my cost of funds is higher. It doesn't, for example, one really good example is that my deposit base is actually less expensive than might be for one of my peers. And that's because my depositors are with us because they do care about what their money does in the world. And they're willing to accept potentially a slightly lower rate to get there. So I think there are trade-offs in business, and I think we find a way to get to the end if we've got people, both in all stakeholder groups, that want to be a part of this mission.
While
Thank
she's
you,
getting her,
Priscilla.
taking her phone call. Oh, I don't know whose phone that was, but anyway. So yeah, that's super. That sort of understanding of the deep impact of these issues and how it really affects thinking of every company increasingly is really important. And I think that's one of the things we think about a lot. We invest across the entire economy, and so we look at companies across the whole economy. Obviously, these issues have different, levels of impact on different companies, but all companies are affected by these issues, the societal pressures and the environmental realities that are increasingly part of the conversation. And I will say, just to go back to something Anaket said, I agree with what he's saying is no one's been paying the price for these issues. But I think what he really means is that certainly in our economic terminology, we've not been accounting for the cost of these issues because the price is being paid, literally in the ground, where we see massive floodings and a rising level. Who knows that the number one natural resource cause of deaths today is heat waves, not hurricanes, heat waves. And you look at what happened in India the last month or two, and that is increasingly coming to a neighborhood near you. So these things have real costs, and the price is being paid by society, governments, everything. As a firm, like Amalgamated, but like 92 years later, we were founded with this mission, and we've been fortunate to attract investors who are exactly what, as Anaket said, willing to take the long-term view and want to see not just good investment returns. They do expect that realistically, but they also know that they also want to see real environmental benefit from the work we're doing. And they've been incredibly patient. We've been fortunate that it's worked pretty well, but they've been very patient on that. So let me just to kind of get to your real question. Let me give an example of the kind of company we've ended up investing in, and we see has made significant strides over the last 7 years in terms of becoming increasingly sustainable. So we've owned Adidas, the German sporting company, since we launched the fund in May of 2015. The original thesis was thematically around a world that is increasingly younger, more urban, and more active. In a world that is increasingly getting hotter and more humid. Adidas and Nike, we own that too, make the kind of materials and are specialists in the kind of materials that people will increasingly wear their clothing. So it was just they were a beneficiary of urban demographics and climate change, effectively. Maybe not intentionally, but unintentionally. What has really been interesting along the way, it's nice that they've been well positioned, they benefit from that, is they've also started to embrace an enabling role. And by enabling, meaning they're helping to help the transition as opposed to just benefiting from it. And that is where we need to see big companies going. And it started really, frankly, by a little bit of accident. Someone had a brilliant idea of making some shoes, some of their running shoes, out of recycled plastic, ocean plastics in this case. They found a source in Parley Ocean Foundation who was pulling ocean plastics out and was looking for a market. They were pelletizing it, looking for a market. And in 2017, they made 1 million shoes, $200 each, and sold out immediately. You couldn't even buy them online. Well, fast forward to 2021, they're made 17 million pairs of shoes using Parley Ocean plastics and recycled plastic materials. And they're increasingly committing to, by 2024, using recycled plastic in all their products. So hence reducing significantly the amount of virgin plastic, which reduces the amount of demand for fossil fuels, and creating some circularity in the economy. And now their total products that are made using partly ocean plastics has generated is annually generating $1 billion in revenues on a company that has 21 billion in euros of revenues. So real business outcome. And the stock happens to have also done incredibly well. The cumulative return since we invested is 185%. And that compares to 91% for the MSCI World during the same period and 22%, 23% for the DAX, the German index. So there are win-win-wins in this. There are huge opportunities. Having said that, there are companies that will just go away. And that's always happened, right, in our economy. It's creative destruction. It is part of it. And this period going forward is going to be one of those transitional periods of massive creative destruction, which also creates opportunities. And we'll see what it means for global GDP growth. I think there's an open question, what happens as we start meeting some more of these limits, but there will be companies that will be significantly better than their peers because of the work they've done to be prepared for this.
Thank you, Tim. So I will use that answer to address a question that came up in the chat, which is, doesn't addressing these issues by definition make it more difficult for the company to compete in an open market? I think that example you just gave clearly demonstrates the answer to that is no. In fact, it facilitates competition.
Yeah, I think it's a competitive imperative now for companies to attract employees and for customers to have a credible sustainability strategy.
Yeah.
10 years ago, you could just have a sustainability report.
Mm-hmm.
I think transparency is, as the term goes, no offense to anyone's language, transparency is the bitch.
Let's talk about that, Tim. Thank you for pointing us in that direction, because metrics, data, and disclosure are an issue that some would consider mundane, others would consider to be critical to the effectiveness of a sustainability strategy, because it leads to authenticity if done right. What are your, I'll give you all a jump ball. What do you think are the issues around measurement of impact, measurement of ESG performance, and how do you and your organizations think about facing the challenges the very real challenges that do exist today?
Yeah, I'm going to just come in here because I think that we are, in some ways, as an industry, barking up the wrong tree when it comes to impact obsession. We are obsessed with quantification right now. And I'm so glad what Tim said earlier about how a lot of his analysis is qualitative and it's about strategy and it's about where folks are going, because we live in this world right now that if you don't put a number to something, it's not real, it's not robust, and so on and so forth. And that is really pernicious, by the way. It's a really weird evolution of our social science and of our society, that if you can't quantify something, it's not real. And then you don't ask the question that when you do have a quantitative number, there are so many qualitative judgments that go into that it is in fact as qualitative as quantitative. There's no better example than, of course, the measurement of GDP, which has been a long-standing debate around what we should actually include in that measurement, which is a qualitative debate, and then we go and stick some numbers into it.
Robert Kennedy had some great thoughts on that.
Absolutely did. 1968, I believe, the speech he gave in South Africa on the shortcomings of the GDP. Absolutely, and look, we are in this now with impact measurements, and every one of my clients has to defend to their clients, to asset owners, that their investments, in quotes, have positive social and environmental impacts. And then they start, and then they go into these very micro level things about number of jobs created and number of this, number of that. And sometimes I think we miss the forest for the trees. no pun intended. So I'm much more of the view that you need to be thinking about direction of travel. We need to be talking about, a lot of these impacts on their own are fairly insignificant, but in totality as a system, it's moving things in the right direction. I think we need to be thinking about impact measurement from an intention perspective as well. What is your intention going into an exercise like the ones that we are all doing? And we should also be thinking about it in terms of both qualitative and quantitative outputs. And so that's one sort of critique I have with our current impact obsession. By the way, I see this all around me in the work that I do with governments in development finance. Organizations like the IFC and USAID and so on, they are, they're so obsessed with these micro level impact measurements, but they don't ask the question, which should be the question, how do you get 1 billion people out of extreme poverty? That's going to require systems change, not, looking at this very micro level stuff. And I think in economics, in the field of development economics, this growth of randomized control trials has in some ways really slowed down systems level thinking. The second point I would just make around impact and investments is that there should be a lot more focus on the interaction between investors and regulators and policymakers, and not just the interaction between investors and companies. Because ultimately, if we want some of these systems level change, the impact will come from actually changing how policymakers set the rules of the game. And I have not seen any impact measurement framework that is really focused on that, although the Net Zero Asset Owners Alliance is now starting to think about this as the future of engagement, which I'm very supportive of. So those are just a couple of thoughts on this, and as reflections of what I see with literally hundreds of my clients and the amount of time they're trying to spend defending, how many jobs are created by some publicly listed company of which they own secondary market shares of. They're just trading shares. They're not even providing new capital to these businesses. And I just think it's frankly a big waste of time. A lot of it is a waste of time.
Thank you, Anaket. Appreciate that very much. And as you have heard me say, the key issue when you're measuring something is not the number itself, it's the authenticity of the data that you're using, the metric that you've developed, and then the rigor that you apply. Because the metric itself just tells you where you are today relative to yesterday. The precision of it isn't what matters, it's the direction of travel. So we are very close to running out of time, which is a shame because I feel like we're just getting warmed up. I want to offer you each just a few minutes to offer a closing thought if you have one. We would certainly welcome that. And again, let's go back to alphabetical order. Ms. Brown, we'll start with you.
Okay. I really like the last two comments you both made. The one around intent is critically important, and this notion of metrics. I think it's more of an and than an or. I think there's both that which has to be measured at the granular level, more tactical level, and that which involves big impactful change. But I think also just matching every statement. A lot of people are talking about this stuff, but matching every statement with action is really key. And that's why, Tim talked about, it's not only supporting the Paris Climate Agreement, but also becoming the first, in his case, asset manager to have those pledges certified by the Science Based Targets Initiative. No matter what we think of that, it's for us, it was important to do because, again, you want to match those statements with real actions. I'd be remiss if I didn't say something on this call about women's rights and healthcare, because that's so topical today, and it is a part of all of this. And so when we support the access to choice, we also have to make sure that pregnant employees and their family members can get the health care they need, whether that means paying for them to get on a plane, paying for their childcare while they're away, addressing in particular the poor and the minority, working poor and minority that exist in all of our organizations or in the suppliers to our organizations, whether it's the cleaning crew or it's the meeting planning company. It really does get down to these local things and making sure that you're providing, when you say you care, you act like you care and you do some things to support that. And I could go on examples. I think the biggest one for me these days is the fact that we don't have a living wage in this country. And so, taking the action within our own companies to enforce that and making sure that it's a requirement of the companies that we do business with. We're only different if we do what we say we're going to do. If we match our words with deeds. And it's easy to say the world needs to change for the better. It's easy to say that someone else in this public-private partnership needs to make it happen. But it's much harder to put our money where our mouth is and do it ourselves. And more employees, investors, and customers are looking for companies that do that. And that's why there's a premium today, and there will be a premium as we go forward on those companies. And that's why the doing well through doing good makes sense. So aligning our money and our clients' money with our values, that's what makes us all ESG leaders. And so I want to applaud again the people on this panel, many of whom are much deeper experts than I am in this topic, both of whom are, but who are not only going through that academic exercise. One of them is getting on a plane to go to dart all over the world to help people in poorer countries understand their contribution and their benefit through all of this. And those of us who are here in the US have the same obligation, just to make sure that we are all doing what we can, and we're telling others that it's unacceptable to do business with us unless they're doing the same.
Amen. And Priscilla, shout out to you for using the word living wage, not minimum wage, because we all know $15 an hour is very different in New York City than it is in Kansas.
That's exactly right. That's exactly right. Thank you.
Tim, what are you thinking?
Well, Priscilla put a whole lot of other things on the table here that are probably more important, but I just going back to reporting and disclosure and all that. Look, the flaw in the capital markets in our economic system has been ultimately an accounting flaw, and it seems really boring, but we need to figure out how to account for the value of people and the environment, because that what drives decision making in the C-suite and in investment firms. And we've for too long gone without properly accounting for that. Now, the good news is that's coming to, the SEC is considering these disclosures. Europe is doing a lot of work on this. There's the International Sustainability Standards Board that's working on new guidance for global reporting systems. So those days seem to be ending where, companies didn't really have a way to measure the value of these elements. And I think that's going to be incredibly powerful. And probably pretty exciting if you're an accounting firm, which is why so many of the big accounting firms are hiring a lot of people. And I think amen to that.
It's a great point. What two just such wonderful thoughts. And I'll leave with a quote that I keep up on my wall in my office. And it's something that I think about a lot. He was a wonderful anthropologist named David Graeber, who sadly died last year, and wrote a brilliant book about debt and has written a lot of important books in his time. And he has a quote called, and it is, "The ultimate hidden truth of the world is that it is something that we create and we could just as easily make differently." And I think about that a lot because, all of this whole system, we created it. We created this financial system. We created this accounting system. We created this way of measuring progress. And we can change it. And this is why, not to be inspirational, but to be practical, the companies that are out there in the world are owned by us. They are our companies. We own them. We own them through our pension funds. We own them through our mutual funds. We own them through where we decide to bank. And we can therefore change it. We can change the rules of the game through policy. And this is why Priscilla's comment is so powerful, that it's not just about having the right idea, but it's then about putting that into action and about making changes in one's daily life to reflect these values. And that is exactly what the position we are in with regards to ESG, with climate and so on. There's a recognition now that these companies are our companies. You know, Rob, you mentioned at the beginning, or sorry, it was Perry at the beginning who talked about the growth in shareholder resolutions. That's really exciting because it's a recognition that these companies are owned by the asset managers. They own the shares of these companies. So I think for one takeaway I have for everyone is that it is about action because it's our world. And the second, because again, we're in an academic environment, is that a lot of these questions are not yet solved. And so get in it, start reading, start writing, start thinking, exploring these ideas, because they're unsolved questions. How cool is it to be working on questions that have not yet been solved? And I think if you go down that exploration, you'll have a very fulfilling career.
Amen to that. Thank you, Anaket, and thank all of you for some wonderful perspective. We do have a few minutes left, and we do have a lot of questions from the audience. So if I can, I will throw these out there to you. We have several questions about the recent SEC proposal to provide guidance for ESG disclosure. And the question is, what's the impact of this to firms and investors, and how best to approach it? Any of you have any thoughts? Or I should say, I know you do.
Thoughts.
Do you have any thoughts you want to share? Exactly.
I mean, it's just to be clear, it's particular, the SEC proposal is around climate related disclosures, not ESG. And I think that's, it's been a very robust process, been going on for several years to better understand the investors' needs for around this information and how relevant material it might be for decision making. And so we are very supportive of the proposals put out, and we hope they go through as just laid out as proposed. However, there is a lot of pushback, particularly around something very wonky, which is called Scope 3 emissions reporting, and its requirement or not. So there's a lot of need for asset owners and asset managers to weigh in with how they use it. We would already use this information. Frankly, it doesn't do much for us, because if we don't have the information, the company's not disclosing it, we don't consider investing in them. So well-run companies are already disclosing this information, but it is important for the capital markets broadly to have ubiquitous disclosure of information that is going to have material implications for any investor who's going to be owning shares in a company.
Just to add to that, I think the most exciting thing to me is not the scope 1, 2, and 3 emissions numbers, because frankly, a lot of the investors we talk to don't even know what to do with that information. But what I like is that the SEC is talking about companies having to describe their transition plans if they have a net zero target. And to Tim's excellent point earlier about the importance of looking at forward strategy and where companies are going and how they're responding to shifting terrain and so on. We think we hope there's going to be a lot of information value from that, because ultimately for companies, these are questions of corporate strategy. Do you want to be a leader? Do you want to be a fast follower? Do you want to be a laggard? Like, every company is going to approach climate differently, and we are very interested in that component of it more so than the hard numbers, which, as we know, even now, even with the greenhouse gas protocol and so on, it is still very difficult to compare two companies' scope 1, 2, and certainly their scope 3 emissions, because the calculations and approaches still are quite different.
Priscilla, as a corporate leader, do you have any thoughts there that you want to share? Hope you're on mute.
Sorry about that. I did that because that was my phone ringing earlier. I can't seem to turn it off. I don't have anything to add to that. I think the point's very well taken, Rob.
Okay.
Well said.
Yep, thank you. Maybe the last question we have around issues of disclosure relates to greenwashing, and what do you do about it?
Why we have analysts. You do research, you do assessing. It's frankly, greenwashing is no different than the current version of greenwashing is no different than the historical version of greenwashing. Lots of companies greenwash their actual earnings reports. I used to cover General Electric, and every year there'd be a debate about what their actual earnings per share were. There was what they said they were, there was what GAAP said they were, there was what the analysts said they were, and many different agreements. So part of the analyst's job is dealing with the messiness and working through what the CEO might say in a beautiful PowerPoint presentation, and see what they're actually doing and how that's going to work. So that's just part of doing analysis of a company and investing in. Just like product assessment, when you're looking at a product and you're saying, is this product really good for the environment? It's difficult, but doesn't mean it's not worth doing.
Yeah, I always say you don't have to agree, but you have to be authentic and rigorous in your disagreement.
That's well said. And then also, in addition to analysts, as a community that's calling companies to task on this, more and more you're seeing companies' own employees and their customers calling them to task on greenwashing, which is, I think, as the whole world learns more, you'll start to see that become commonplace.
And let me just add one thing on greenwashing. I think it's one of these, it's become effectively a slur these days, and I actually take issue with it because these things are hard. Okay, it's really hard if you're a CEO of a company and you're trying to move a company in a different direction. And part of that is about having big goals. And it is about saying that this is where we're trying to get to. Now, for companies to avoid greenwashing, it's to say, this is where we're trying to get to. This is what we can do. This is what we don't know how to do yet. So it's about being honest about that. But I think what we shouldn't have, we live in a very cynical world right now. Everything is negative. Everything is cynicism. We're questioning intentions and motives of everyone. And I would just say to folks, it's very easy to criticize. It's very easy to say that everything that everyone's doing is BS and greenwashing and everything's bad. It's just more complicated than that, folks.
Yes.
And companies need to be honest about what they can do and what they can't. And many companies are. They say, look, this part of our future emissions reduction, we don't know how to do it yet. We hope the technology gets there. We hope consumer preferences change. We hope there's a carbon tax. But let's not throw out the proverbial baby with the bathwater, because right now the greenwashing concern and pressures is so enormous that what I worry about is it decreases people's ambitions. It decreases people's vision of where they want to go.
Yeah.
And I actually see that as the bigger risk right now, not companies misleading people on what they're doing on ESG.
Really well said, Anaket. And for some perspective, I think it's worth remembering that perhaps the modern day ESG movement began in 1974 at General Motors, of all places, with the Reverend Sullivan, who was a member of the board who authored the Sullivan Principles, that were really a series of 9 and then 12 practices for dealing with companies in South Africa, which ultimately led to the end of apartheid. And if you think about that relative to where we are today, we are not done. There's a lot of work to do, but we certainly have come a long way. And I think that perspective on matters of society, on matters of the environment, and on matters of governance is really important. So thank you all for sharing your perspective. Thank you all for being here. We are out of time, unfortunately, but it's been wonderful having you all. Thank you. I know I'll speak to you all soon, and on behalf of everybody at Brandeis University, at the International Business School, thank you.